Well, hey there, everyone. If you're listening to this and thinking, man, my portfolio feels like it's been on a roller coaster lately, well, this deep dive is definitely for you.
Absolutely.
Today, we are tackling position sizing.
Yeah.
And no, it's not about like where you sit when you check your stocks. It's about managing risk, especially when the market feels a little bit like it's gone crazy, which, let's be honest, September 2024 has kind of been a wild ride. We are diving into some listener-submitted material today from Investopedia to understand this really crucial aspect of investing.
It's a good one.
Yeah.
Yeah.
And joining me to help decode all the jargon and find those aha moments is our expert in all things finance.
Hey, everyone. Happy to be here.
Okay, let's unpack this Investopedia. They define position sizing as the number of units invested in a particular security.
Right.
Sounds pretty simple, right?
Yeah.
But I have a feeling there's a little bit more to it than just saying like, well, I bought 10 shares. I'm good.
Yeah, you got it. It's a little bit like saying baking is just mixing ingredients. It's like, yeah, that's technically true, but the magic really is kind of in like the proportions and how much of each thing you use. So
Yeah.
position sizing really is about strategically deciding on that number of units that makes sense for you based on how much risk you're willing to take, the size of your account.
Yeah.
Even how the market's doing, which, you said it's been a little dramatic out there.
Yeah, a little bit.
Little bit. So it's less about, throwing all your money at something and crossing your fingers. It's about making these smart moves for the long term.
So it's more calculated moves rather than gambling.
Exactly.
Huh.
Think of it this way. You wouldn't put your entire travel fund down on one hand of blackjack, would you?
Probably not.
Right. Exactly. It's
Yeah.
about playing the long game, being strategic. And the cool thing is, this applies whether you're like a day trader. You're in there every day or you're just starting out.
Yeah, and that's actually what caught my eye too, because they emphasize in the article, this isn't just for like the super Wall Street trader types. This is for anyone who's like, I want to be smarter about my money, which honestly is probably all of us.
Totally.
Yeah.
It's about protecting yourself from those like unexpected, market swings.
Yeah.
No matter what your style is.
So speaking of protection, there's this little guideline they mention, the 2% rule. Have you heard of this? Okay.
The 2% rule. Yeah, the 2% rule is kind of like setting a speed limit for your investments.
Okay.
It basically suggests that you shouldn't risk more than 2% of like your total investment capital on a single trade.
A speed limit for investments. I like that. So it's about knowing when to pump the brakes a little bit, especially when things are getting extra volatile.
Yeah, exactly. It's about protecting yourself from those like
Yeah.
moments in the market,
Yeah.
So let's say you have $25,000 in your investment account. Using that 2% rule, you wouldn't want to risk more than $500 on any single trade,
Okay.
no matter how good it seems.
So even if I think I found like the next Apple or Amazon, I shouldn't go all in with everything I have?
That's the idea. Sticking to this 2%, you're basically building in that cushion, that safety net. So even if you had a run of bad luck, let's say 5 losing trades in a row.
5. Okay. See, now that's a scenario I don't even like to think about. But I guess it's possible.
It is. That's the point we're planning for it. So
Yeah.
even with those 5 losses, you're only down 10% of your total capital.
Okay.
Still a loss.
Yeah.
Not ideal.
Right.
But it's manageable. You have room to recover, to learn, adjust your strategy.
Okay. So it's not like my entire portfolio is going up in smoke.
Exactly.
Okay. That makes me feel a little bit better. But how do we actually figure out that magic number for each investment? Because the article talks about these 3 key things: account risk, trade risk, and then position size. And they even use this travel analogy, which I thought was kind of a fun way to think about it.
Yeah. It's a good analogy. Makes it really relatable.
Yeah.
They compare account risk to your overall travel budget.
Yeah.
So not just like the total amount of money you have, but how much are you actually comfortable spending?
Right. Like, I might technically have enough for a first-class ticket, but I probably sleep better at night knowing I booked economy and
Yeah.
have some extra cash for, whatever comes up.
Exactly. And then trade risk is like those unexpected costs that always
Yeah.
seem to pop up on trips. Flight delays, lost luggage, things like that.
The just-in-case fund
Exactly.
for when things go wrong.
Yeah.
But in, like, the investment world.
Exactly.
Okay. All right, I'm with you. I'm following. But how does this then translate into an actual position size?
So think of position size as like figuring out how many souvenirs you can buy
Okay.
based on your budget and accounting for some of those surprise expenses.
Mhm.
So it's not just about how much you want to spend, but what you can responsibly spend after you factor in the bigger picture.
Okay, I see how that all ties together. So how does this actually play out, though? Like, give me an example, because they mentioned Apple stock.
Right. So let's say you're interested in buying some Apple stock and you're comfortable with that 2% account risk on this trade. You've got your $25,000. That means you're okay with potentially losing $500,
Got it.
right? That's our kind of safety net for this particular investment.
Same as the 2% rule from before.
Exactly. Now, let's assume Apple is currently trading at, let's say, $160 a share.
Okay.
And based on your research and your risk tolerance, you decide to set what's called a stop-loss order
A stop-loss order.
at $140.
Hold on. Can you explain that for those of us who maybe are just dipping our toes into the investing world? What is a stop-loss order?
Yeah, so stop-loss order is basically like your safety net in action.
Okay.
It's an order that you would place with your broker to automatically sell your stock if it hits a certain price, in this case, $140. So it's designed to limit your losses if the trade goes against you.
So it's like an emergency exit strategy I set up in advance just in case things go south.
Okay, you got it. So the difference between your buy price, $160, and your stop-loss price, $140.
Right.
So that $20 difference, that's your trade risk per share.
Okay.
Does that make sense?
Yeah. It's like saying I'm okay with potentially losing $20 per share, but like no more than that.
Exactly, you got it.
Okay.
To calculate your position size, which is how many shares you can actually buy, you would divide your account risk, that $500, by that trade risk per share, that $20, which in this case would give you 25 shares.
So I'm not just throwing darts at a board and like hoping for the best.
You are.
There's actual strategy and math behind it.
Yeah, there's a method to the madness.
Okay. All right. I'm liking this. So now, before everyone runs off to buy a bunch of Apple stock, there's this other little thing they mention, and it sounds kind of scary, to be honest. It's called gap risk. Can you explain what that is?
So imagine this. You've done all your calculations, you're feeling good about your Apple stock, and then bam, something unexpected happens.
Like what? A surprise hailstorm at Disney World? Because that's the kind of luck I have with unexpected events.
Let's hope not.
Mm-hmm.
Think more along the lines of like a sudden economic downturn. Or maybe Apple's big new gadget that everyone's excited about. It totally flops.
Okay, so not a hailstorm, but still a storm that investors want to avoid.
Exactly. And investors get spooked and they start selling off their Apple stock, and the price plummets way faster and further than anyone was expecting.
So that's the gap in gap risk. It's like the stock price is playing hopscotch and completely skips over your carefully placed stop loss order.
Exactly.
Yeah.
That's a great way to put it. Your stop loss was at $140 to limit your losses. But what if the price plunges all the way down to $130 before your order can even go through? Suddenly that safety net you set up, it's got a hole in it.
Okay, this is making me want to just like put all my money in a piggy bank and hide it. But I know that's not the answer.
Yeah.
So how do you even plan for something that you can't predict? How do you avoid those gap risk potholes?
Well, you can't completely eliminate risk in investing. That's just part of the game. But you can be smart about it. And the article makes a good point that especially during times of high volatility, so when the market's extra jumpy, you want to be even more cautious with your position sizing.
So maybe don't bet the whole farm on Apple right before a big product launch, just in case it's a dud.
Exactly. Consider being a little more conservative. Maybe even having your usual position size when things are uncertain. It's about being flexible and adapting to whatever the market's throwing at you.
Okay, I like that flexibility is key. This has been a really great deep dive. We went from like a dictionary definition of position sizing to actually feeling like we can apply these concepts to be smarter, more calculated investors, which I'm all about.
Yeah, the big takeaway here is that position sizing isn't just some arbitrary rule. It's really about aligning your investments with what you're comfortable with risk-wise. And always having a plan, knowing how much you're willing to lose before you even think about hitting that buy button.
So to sum it all up, don't put all your eggs in one basket. Always have an escape route and watch out for those potholes.
Well said. Couldn't have said it better myself.
And to all our listeners out there, if you want to learn more about position sizing, we highly recommend you check out that Investopedia article. We'll link it in the show notes. Until next time, happy investing, everyone.